大家早上好，中午好，晚上好啊、不知道您在哪里啊？所以主要是我们提前几分钟开始，我发的帖子估计可能有些人看到了啊，open 到没有出乎意料啊，唯一的有一个地方就是比我预想中还要好一点，就是它在第一季度，我原先估计是在第二季度，它现在提前就实现了盈利，这意味着我之前对它收入毛利就是预估是基本一致的，但是呢，它公司的就是从运营上可能比原来更省钱，所以呢，提前实现了盈利，这当然是好事，所以现在就差回购了，所以这家公司应该没有问题，所以呢，我就今天不是号召大家饮酒啊，开了一瓶宇治茶美酒，所以这里面是美酒，度数很低的，但是它里面加了绿茶，所以没有喝过。所以一边跟大家听，然后一边自己稍微喝一点点，但今天呢，就是听完可能就差不多了。然后因为没有太多时间，因为现在比较困，可能要一会儿还不能睡觉，因为上午还有事儿要出去，所以下午才能睡觉。估计要再做视频讲 OPENDOOR具体的财报，可能要到晚上了。OK， 希望大家理解。味道还不错，还有茶，有那个喜欢的日本绿茶味道啊。我们首先讲一下他给股东的信里面的主要内容啊，就是非常非常乐观啊，所以大家应该看到这个，然后就是建议大家仔细看这条信，就是 Eric 同学，我觉得这封信比之前的信写的都好，我一会儿会讲。前面讲他这个市场是多么大。然后这个季度是收入是5.2个 billion， 跟我们昨天预估是几乎一致的，590% 啊，毛利535个 million， 贡献利润332，第一次实现了会计的利润，然后虽然只有20几个 million， 所以也不错了。然后而且更重要的是后面他对整个他公司的判断，我觉得这比具体的数字要更。对我鼓励更大，就是之前我其实抱怨我说他们没有更新过他们市场的预期，之前讲说他们市场好像只能做到几十个，现在他讲说原先我们不知道能不能在美国的每个市场我们都可以成功，今天我们非常相信自己在全国所有的市场都可以做已经扩大了很大市场。然后而且他这里边就是我之所以说这次写得好，我刚才讲那个 offer pad， 不知道可能有些朋友没有时间去听，他那个 CFO 也讲了同样的话，就是因为很多人现在担心利率上升啊，大家买不起房啊，然后而且你那个对利率是不是很敏感啊？比如你的成本会增加，他就讲了这些同样的，我在 offer pad 里面讲了，这些就不讲了，就是为什么这些对他没有什么大的影响的原因。OK， 所以总体呢非常非常乐观的，然后这是他得到的那些 request 也增长了2倍以上，然后而且我觉得他很好的就是他这一次好像第一次在信里面把他之前没有细节讲过的这些附加的服务title escrow 这些也讲了一下，就是他就说推出的这些卖房之后推出的相应的产品，现在那个跟进率也很高，这说 80% attach， 就是说100个通过他这卖房的有80%，然后就80个同样也用他的那个 title 跟 escrow，然后这都是很好的，所以呢现在有48个 market，OK。而且你看它的毛利现在是10.4%，比我们昨天印象里中位数好像是10，就比机构想的还要高一些。而且更了不起的是说，现在我看，因为它的房价在网上都公布的嘛，所以很多人推断它现在4月份现在我们是5月份第一周了嘛，4月份和5月份第一周数字看起来，它的毛利从一季度的10%，现在据说能达到15%到17%。就是2季度肯定盈利更好，然后，而且我之前讲过，他上年3季度为了猎杀 Zero 搞了很多 inventory，他现在 因为它买的比卖的要少，所以它现在 inventory 就是总共存货的房屋存货的水平也到了一个相对比较平均的一个健康水平，就还是受了一些内伤了，就是把别人干死了，自己也不是毫无影响。所以呢，你看他这里就是说，就他们卖房很快。guidance 它是第二季度是4.1到4.4，所以这个两个加起来超过9点几个 billion 啊，就跟我原先预想，我说它全年应该到20个 billion 甚至22，就是上半年现在看下来，至少可能是如果10不到的话，应该至少做到9.5，所以应该是非常不错的。所以9.3到9.5上半年估计实际上可能快接近10，因为它通常给的预期很保守。而且你看它的股票薪酬也很有克制，过去几个季度，这个我在推算中用的数字跟这个差不多，就7000多万美金的股票薪酬费用。所以说是，而且它很有意思，还加了一个市场的预期它整个市场预期很好的这些，然后而且它这里面单独加了一个部分，就讲说就市场之前很多担心说，如果是市场如果特别一下变坏了怎么样，他就讲了说，其实我们所有的模型早就把这些都已经考虑到了，市场不是一天就会变坏的。很多人讲起经济危机来，好像一夜之间就什么情况很恶劣，其实不是的，它就是个很缓慢的过程。而且它这个市场今天其实 OfferPad 我忘了讲 ，OfferPad 管理层也讲到同样的观点，他说现在这种火热的市场对这种互联网买房 iBuying 其实非常不利，因为大家现在随时都可以非常容易的卖出去，所以它这个 iBuying 它这种快速快捷让你很快可以有流动性，这个功能性显得就没有那么有必要，对吧？所以它其实给人家讲起来就腰杆子不硬。如果是到了真正的就是买方市场，但卖房子比较难，如果是经济确实不好了，那他反而他有讨价还价，他就可以向对方就是卖房的收取更高的费用。所以呢，就是说不管房热还是冷，房市就是它这个形式应该都没问题。那这个季度既然能实现了盈利，就至少就是对市场有一个很好的警示，就是说这家公司长期是可以实现盈利的，而且应该未来盈利越来越好由于它的成本费用管理比较好。所以呢，就是没有看到任何好像值得任何担心的事情，跟预想的几乎一样。看大家有什么问题再那个回答一下。那个靠的那个不用担心，我相信明天的价格不是现在的10%的涨幅，这个我一点不担心，而且我买的很少嘛，就是我最近的几次的操作，大家可能看到了，就是我还是买的长期的期权比较多，而且我在2家当中 OPENDOOR 和 Upstart，我印象里之前的期权也是这样，因为 OPENDOOR 一直期权比较便宜，所以我之前也买了很多长期的期权，所以明天看一下应该还不错。期权我会看，期权我建议多数人没有必要考虑，但是如果是你之前有了解的，然后它可以做一个补充。所以我跟一个网友在会员留言区有交流，然后我觉得他提的一些也挺有意思的，然后我也在考虑，就是期权本身如果是不太危险的话，然后如果长期比较合理的利用，它对这种长期投资没有冲突，而且是一个比较有力的补充。尤其是比如说这个公司你知道它的未来是像真正亚马逊 Google 一样，然后未来会越来越爆发，市场对它的理解越来越清楚，所以期权其实给你是一个加权但是我确实同意，我觉得你如果是觉得这个比较复杂，没有必要考虑，买正股一点不用担心Upstart 更没有问题 ，OK，Upstart 就更不用担心。 就是 OpenDOOR， 我之前对它的担心说，比如说第一个，我不知道它这个季度会不会盈利，就是它当然盈利非常好。第二个，我不知道管理层能不能对未来就是有非常好的预期，而且那个语气能非常强，至少我刚才讲，从 Eric 那封信当中，比以前的语气就显得特别的 affirmative， 就特别肯定说，我们确信我们可以成功，而且我们现在真正实现盈利。所以呢，我觉得这是非常好的一个，就是让我至少感觉现在稍微放心了一点。就是它总体还是我觉得太低调。你做投资者，像我们这种人低调 OK 啊，但你做 CEO 了，你要对华尔街去讲，然后太低调了也不好大家有没有什么具体的问题？好像没有了我看见不用担心我水上水下的问题 OK，1%， 而且我估计不会在水下。Square 我对不起，我还没有看，我不知道 Square 现在的情况怎么样了。Upstart 更没有问题Upstart 更放心。因为我这个美酒买了2瓶，然后还有1瓶是等 Upstart 之后再开。看一下他那个会议开始了没有？OK， 还没。西方石油我还会讲，我之前不是说过了，大家没有我说过的事情都会做虽然我因为东西排得很满，不见得会非常及时，但是西方石油我印象里是还有1周，对不对？所以应该是发了财报，因为那个讲很容易讲就是它石油公司 OK， 所以那个非常稳定，只要油价在那儿，然后利润什么，就是其他的就无非是看管理层，比如回购多少，然后股息多少，然后这些，所以应该没问题。干杯，味道还不错，因为它有一点那个梅子的味道稍微有点酒精，好像是8%不到，然后还有点绿茶的味道。不是建议大家喝酒我很少喝酒，因为我也没有应酬只是稍微有点仪式感，OpenDOOR 确实比 Upstart 好处在于说，我之前讲过，它总体的因为波动没有那么大，就是它没有上过非常高Upstart 20上到420倍，它好像只有2-3倍，对不对？所以它的整体的期权一直都很便宜，一直都比较便宜，所以我 Upstart 当然是持股最高，但是 OpenDOOR 相对来讲，我的期权比 Upstart 期权要高，因为 Upstart 期权老感觉一直没有特别便宜对，这位朋友说，他把那个贡献利润率的长期指引提到了7到9。对，我希望管理层能够非常清楚的在这次会议当中讲清楚说，比如说我原先跟你们讲过，说我 SPAC 上市时候，我说我们可以把生意做到50个 billion 现在我们可以做到500个 billion。比如说这是第一个。第二个，我们原先认为20-40个市场，我们现在认为美国80%的市场所有的州郡我们都可以去这是第二个。第三个就是我们对长期的贡献利润率现在可以提到7到9甚至更高第四个，然后我长期如果算上相应的服务，然后我长期可以保持什么样的那种纯利润的水平然后呢，就是如果比这个还更好的话，我是希望它可能回购太早，但是我是希望它能够对华尔街然后做出承诺，说在适当情况下会考虑回购。Upstart 对做空，其实我不知道为什么那么多人对做空 Upstart 那么有信心，看他们的情况吧，我觉得这些人应该挺惨的。OK， 我们差1分钟，我们开始了 Upstart 好像到了一个部位了，因为他也在买啊，他公司也在回购自己的股票。我估计可能管理层正在酝酿着怎么狙击那个做空的这些人，然后让他们那个 short squeeze 一下，也不排除这种可能。我相信 Upstart 会大幅超过，然后提高全面的指引，然后而且整体对未来的产品应该给非常正面的评价。OK，这是我对 Upstart 的预期。OK， 我们看一下它会议应该开始了。还没有。OK， 开始了，大家告诉我一下啊，因为我如果是我这里视频里面录到音乐 ，YouTube 就会告诉我侵权，我需要把这部分拿掉，就很讨厌。Square 有人知道情况怎么样了吗？对不起，我没有看 Square 的情况。好像盘后也在上涨，所以还不错，100块。这种熊市就是这样的，熊市就会把那个很差的公司、一般的公司跟很好的公司，然后用这个流程把它区分开来。所以我觉得 OpenDoor、Upstart、Square， 我觉得这都是很好的公司。那个会议开始了吗？如果开始了，哪位同学告诉我一下？没有 ，Auto Loan 一开始就会盈利，它是盈利是说，看利润水平，就是因为它一开始的，我上次讲过，它那个 Auto 会先放在自己的 balance sheet， 所以它不会卖给别人，所以它其实那个盈利水平很低，所以明天会卖掉啊，应该会卖掉，除非再从哪再拿到钱。OK， 开始了吗
？The Investor Relations section of the company's corporate website. Before we start, I would like to remind you that the following discussion contains forward-looking statements within the meaning of the federal securities laws, including, but not limited to, statements regarding OpenDoor's financial condition, anticipated financial performance, business strategy and plans, market opportunity and expansion, and management objectives for future operations. These statements are neither promises nor guarantees and involve risks and uncertainties that may cause actual results to differ materially from those discussed here. Additional information that could cause actual results to differ from forward-looking statements can be found in the Risk Factors section of OpenDoor's most recent annual report on Form 10-K for the year ended December 31st, 2021. Any forward-looking statements made in this conference call, including responses to your questions, are based on management's current expectations and assumptions as of today, and OpenDoor assumes no obligation to update or revise them, whether as a result of new developments or otherwise, except as required by law. The following discussion contains references to certain non-GAAP financial measures. The company believes these non-GAAP financial measures are useful to investors as supplemental operational measurements to evaluate the company's financial performance. For a reconciliation of each of these non-GAAP financial measures to the most directly comparable GAAP metric, please see our website at investor.opendoor.com. I will now turn the call over to Eric Wu, co-founder, chairman, and chief executive officer of OpenDoor.
Good afternoon. On the call with me is Carrie Wheeler, our chief financial officer, and Andrew Lewacki, our president. Our customer experience is the focal point of what we do here at OpenDoor. So as always, I want to start this call by hearing from one of our recent customers, the Blasingame family.
My name is Stefan Blasingame. I live in Surprise, Arizona. The biggest challenge of moving was we were going to need to sell our home to buy another home. Not only do we have to do that, but we have to compete against the possibility of all cash offers, Another big challenge for us with a family is the logistical side of selling a home and buying a home at the same time. When I first found out about Opendoor, I was kind of trying it out. We scheduled the tour. I got to schedule the time when we wanted or were able to go see it. There was no pressure with it. Opendoor gave us the ability from our own home to be able to find a new home, sell our current home, and make it all happen at one time in the most simple process ever without having to go through the traditional methods of feeling overwhelmed with it all. What Opendoor has unlocked for us is to know that we can move on our own terms.
The Blasting Games, alongside more than 100,000 happy customers, are the reason why we know we will transform the broken offline process into a digital seamless experience. As we reshape the consumer experience, we are also building a durable generational company. This means not only driving rapid growth, but also sustainable margin improvements and reduction in our cost structure that enable us to grow and be profitable across economic cycles. Our first quarter results are a testament to this effort. We surpassed our expectations, delivering record revenue of $5.2 billion, gross profit of $535 million, and contribution profit of $332 million. We also demonstrated profitability with adjusted EBITDA of $176 million and adjusted net income of $99 million. These past 8 years of investments and hard work on our cost structure, automation, technology platform, and pricing engine are enabling us to deliver durable margin improvements as we scale. Alongside our progress in our key financial metrics, we also continue to make improvements against our consumer flywheel. For home sellers, adoption continues to accelerate, with offer requests up threefold versus prior year. And our re-engagement strategy is also successfully fueling growth. Most encouragingly, we've been able to maintain real seller conversion at over 35% and NPS north of 80. For home buyers, we hit all-time highs for purchase offers, driven by the adoption of Opendoor backed offers and Opendoor Complete. We've also continued to make progress on our financing offering, including adding Lower.com as a strategic partner, which will enable us to offer a broader suite of products, serve more customers across our market footprint, and add fulfillment flexibility as we launch our digital Opendoor financing app in coming weeks. And finally, we continue to take major steps towards our goal of servicing every home seller and home buyer across the country. We recently entered some of the largest markets, including San Francisco Bay Area, New York, and New Jersey, and we continue to demonstrate that we can operate in all markets in the U.S. Before I turn the call over to Carrie, I wanted to touch base on some of the macro dynamics impacting the short to medium-term outlook for housing. While rising interest rates and waning affordability are factors we monitor very closely, we are confident in our ability to hit our financial targets across cycles. First, we have made significant progress in our margins, driving 240 basis points of structural improvements via cost reduction and services attached since 2018, which gives us the necessary margin of safety in our unit economics. Second, if you study the data, housing recessions have been historically slow. And last, we hold highly liquid homes for short periods of time, aiming to turn our inventory every 90 to 100 days. Setting aside the fact that our forecasts incorporate risk and volatility, the combination of very healthy margins driven by structural price and cost improvements and our short duration, sale-ready inventory makes navigating market turbulence very manageable. In summary, this quarter marked another step along our journey to transform the real estate industry. While I am encouraged by our financial performance, I'm most proud of how we delivered these results. We focused on delivering system-level changes that enable us to drive sustainable margin improvements. We focused on our company culture, ensuring that we show up as one team, combining the best technology with operational excellence. And last, we focused on the consumer experience, building and innovating on products and services that will delight customers for decades to come. I will now turn it over to Carrie to discuss our financial performance in more detail.
Thanks, Eric. Before I discuss our Q1 results, I wanted to note that we've updated our annual investor presentation. You can find that on our investor relations website. And as always, please refer to our shareholder letter and our upcoming 10-Q for full details of the quarter. Moving on now to some key highlights. As Eric mentioned, we delivered another record quarter where we significantly outperformed our expectations on growth and profitability. We saw all-time highs in our quarterly revenue, gross profit, contribution profit, and EBITDA. In addition, we generated nearly $100 million in adjusted net income, which for us is a good proxy for operating free cash flow and a strong testament to our growing scale, margin sustainability, and ongoing cost structure improvements. Based on the momentum we're seeing across the business, we expect to continue to drive exceptional year-over-year growth through the rest of 2022. I'd like to focus now on a few areas that are topical in today's environment, namely our margin sustainability and our expectations for how housing will trend over the coming quarters. First, it's important to reiterate that what is core to our business model, and frankly, what is most misunderstood, is that our systems and margin structure are designed to be durable across different housing environments. That's not to say we're immune. Housing dynamics are a key input to our business, and we've custom-built our pricing and operational systems to give us a deep understanding of the underlying drivers and to be able to dynamically adjust to changing conditions. That's reflected in our offers, and those account for the level of certainty in our home acquisition pricing, inclusive of forecasted HPA. And in environments of high volatility, our models are designed to be more conservative. Combining this with holding liquid, sale-ready homes and having updated views on home pricing on a daily basis gives us the confidence that we can deliver against our baseline annual contribution margin targets of 4-6% across market cycles. To that end, with respect to what we're seeing in the macro environment, our expectation is that the housing industry may begin to experience a slowing in HPA and transaction volumes beyond what's normal from seasonal trends, beginning in the second half of this year, the pace of which should be gradual and consistent with a typical slowdown. There's a reasonable chance that housing is going to continue to be stronger for longer. But notwithstanding that, we have been and continue to be conservative in our home valuations in light of greater macro uncertainty. And at the same time as we've been adjusting our pricing to be more conservative, we've not seen an impact on our conversion. Our macro viewpoint is underpinned by what's happening on the supply side. We continue to operate in an historically low inventory market, which has been the predominant driver of home price increases over the last 2 years. This supply dynamic differentiates current conditions from what led to the last housing downturn, which was during the global financial crisis. At that time, we saw very high levels of consumer leverage and willingness to take on debt at high rates that all resulted in a demand-driven bubble, even though housing supply was high and increasing. This led to multi-year de-levering behavior as well as the forced selling of assets during the GFC and subsequent recovery. In contrast, the significant de-levering, higher savings rates, and lower household formation rates post-GFC have resulted in debt-to-income ratios today that are well under those observed prior to the GFC. While affordability has waned with increasing prices over the last 2 years, there is currently little risk of forced selling given the strength of consumer balance sheets. Notwithstanding, real estate prices have tended to move slowly in market declines. Outside of the GFC, there have been only 6 quarters of HPA declines out of 188 since 1975, all very modest at around 1% or less. This further renders a sharp housing downturn unlikely in our view. And even during the GFC, the largest price decline sustained in a single quarter was down 3%. On the interest rate front, while market expectations for Fed rate increases have translated to higher mortgage rates, it's worth noting that real rates today remain reasonable at around 2% compared to the pre-pandemic average of 2.5% and a pre-GFC average of 4.5%. Based on the long-term relationship between real rates and demand, again, it would suggest a gradual softening in for-purchase mortgage applications as rates rise, rather than a sharp downturn. What's the upshot of all this? First, we expect the housing industry to gradually slow, and 2, we're confident in our ability to respond to changing conditions and to deliver on our stated margin goals. Furthermore, as homeowners have to navigate the changing housing market, the simplicity, certainty, and speed that we offer relative to the traditional listing process will only become more valuable to consumers, allowing us to be a share gainer across cycles. Turning now to our guidance for Q2. We expect to continue to deliver substantial year-on-year growth. Revenue is expected to be between $4.1 to $4.3 billion, representing over 250% growth at the midpoint. This amounts to revenue of $9.3 to $9.5 billion for the first half of this year versus our prior expectations for $8 billion. We expect adjusted EBITDA to be between $170 and $190 million, which represents an EBITDA margin of 4.3% and a year-over-year increase of over 600% at the midpoint of the range. Adjusted operating expenses are expected to increase sequentially by approximately $35 million, and contribution margins are also expected to increase sequentially in the second quarter. We are continuing to manage our business against a baseline annual contribution margin range of 4 to 6%. However, we are going to be opportunistic from time to time and choose to capture additional margin when market conditions are exceptionally strong, and we expect that dynamic to be the case in Q2. Before I open the call for questions, I want to thank all of our teammates at Opendoor. I'm proud of all that we continue to achieve together in delighting our customers with building a durable generational company. And with that, I will now open up the call for questions. Thanks.
If you'd like to ask a question at this time, please press the star, then the number 1 key on your touch-tone telephone. To withdraw your question, press the pound key. Again, that is star, then 1 to ask a question. Our first question comes from Jason Helfstein with Oppenheimer.
Hey, this is Chad on for Jason. Could you give a little bit more color on what drove the strength in gross margin in the quarter, and then the assumingly implied further improvement in 2Q? And then how should we think about the back half of the year? And I have one follow-up.
Hey, Chad, it's Carrie. I'll take that. So with respect to what we saw in Q1, I would think about the results being a more normal quarter relative to what we saw prior quarter in Q4, where we were working some of the operational constraints we had. So normalized margins in Q1, and then trending into Q2, we're calling for a sequential tick up in margins, really driven by the fact that, as we commented in our shareholder letter, we have been increasing our spreads since late last fall in light of what we perceive to be increasing market volatility, and we're leaning into margin, and you'll see that show up in our Q2 numbers.
Okay, great, thank you. And then how should we think about inventory through the rest of the year? Is that still kind of building through the back half?
Yeah, no, we said that Q1 should mark the low point for inventory for the year, that $4.6 billion, and we expect to grow inventory through the balance of the year.
Okay, great, thank you.
Our next question comes from Ygal Arounian with Wedbush.
Hey guys, good afternoon. Just first, a follow-up on the inventory. Is there anything to read into commentary about the expectations of the housing market and slowing HPA and slowing transactions and the number of transactions you had here in 1Q? Relative to what you purchased, I guess.
Yeah, I mean, a couple comments I'll make. So first of all, Q1, and we talked a little bit about the cadence of the quarters already in the prior quarter, but Q1 really for us was the fact that we showed up with a really healthy base of inventory, and we met very strong elevated demand for housing. We expected to see really high sell-through rates for inventory, and we did, but we probably sold more homes than we even had guided to. In addition, we saw a little bit of pull-through of demand, and we'd expected to see some of that. We'd sized it at around $300 million of what we saw in Q1 was a function of people closing homes faster than we otherwise would have expected, pulling those homes from what would have fallen into Q2 into Q1. So that was a bit of a driver of the results, but certainly not a major one. I think your question also speaks to what are we propositing for the rest of the year with respect to housing. I mean, as we said in our comments, what we're seeing right now, or at least what we're managing against, is an assumption that the housing market will cool towards the back half of the year. There will be a gradual slowing of HPA and volumes in light of rising interest rates and the pressures we're seeing on affordability. But as we also said, we expect to grow through that. Our offer shows up with certainty and what we think is an increasing value proposition in this kind of market.
Right. I guess what I was trying to get at was, as you tying together that view with your transactions, like are you buying fewer homes than you might because you think I fully understand that and agree with your views on the market overall, not at a collapse. There are plenty of fundamental, structurally positive things in the market, but you adjust the pace of your purchases based on that view, and so maybe you take a little bit of a step back if you think we're headed in that kind of market over the next 6 months.
No, not at all. What we have been doing since last fall is we have been increasing our spreads, but that hasn't inhibited either our conversion or our pace of acquisition growth. And we expect to continue to grow acquisition volumes. They'll be up in Q2, and so long as we can meet our margin targets, we'll continue to grow our acquisition volumes. I think that's a really important takeaway. We've been with increasing spreads, and yet at the same time, we've not seen a real market impact to conversion, and we've been growing acquisition volumes. Back to this comment that in this environment, our value prop should only increase in times of greater volatility.
Okay, that's really helpful.
I'd love to add on top of that, which is
great.
I'll said a different way. The value we're delivering to consumers is exceeding the value we're capturing. And as we've increased spreads, we haven't seen a material impact to our conversion, which is an incredible sign that, again, if we deliver certainty, simplicity, and speed to consumers, they will convert. And so we're excited to see that not only have our margins improved, we've also seen conversion held steady through this period, which gives us a lot of confidence that we continue to grow through the back half of this year.
Okay, awesome. That's really helpful. And then maybe just any color on so far, I know it's early, but the moves into the Bay Area, New York, New Jersey, anything you're seeing in those markets different, the same as the others, just any kind of signs one way or the other on how things are progressing there? Thank you.
Hey, Colin, it's Andrew. The early indications, and it's still really early, obviously, on the Bay Area and New York, New Jersey, are strong. And in fact, I'd extend that statement to all of the markets that we launched in 2021, where we added 23 markets over the course of the year. Those markets continue to perform in a very predictable way as we execute our playbook against them. And we're pleased with New York, New Jersey. We're also pleased with the 23 we launched last year.
Great, thanks.
Our next question comes from Ryan McKeveny with Zelman.
Hey, thank you, and congrats on the results, and appreciate the added details on the business, the cost structure, and the embedded macro views. It's definitely helpful to see you guys lay that out, given the uncertainty that is out there. So Eric, I wanted to dig into a topic you got into the last couple quarters on the long-term ecosystem being a two-sided local marketplace for sellers and buyers. And I think it's interesting to think through. So on the buy side, it's obviously great to hear that the purchase offers with buyers hit an all-time high. But I guess more broadly on this kind of flywheel opportunity with buyers and sellers, if we look at it as the aggregation of local supply is important to aggregating and capturing that high intent demand, is there a threshold of market share at the local level that we should think about as to when you get to a certain level of market share of supply that buy side really starts to flourish, or is that still kind of early days to get too much into that?
Hey Ryan, it's a valid question. The way that I think about it is that if we're able to aggregate supply, in our case it's actually unique supply, it's our inventory, we can then build a differentiated experience on top of that supply. And really the end state that we're building is that we want to make it possible to be able to buy a home with peace of mind with just your mobile device. And we're using our inventory to build that experience as the first step. In terms of aggregating demand with that unique supply, we are seeing really good progress and signal that we're able to do that. When the market tips, and maybe to try to define that term where every single buyer in market is looking, downloading, and using our app to shop, we're not certain. But we do see really good correlation with if we increase supply that we have and build a differentiated experience on top of that supply, buyers are actually using Open Door directly.
Got it. That's very helpful, Eric. And one more on the topic of the acquisition underwriting and obviously the spread dynamic, and Carrie, really helpful to hear your commentary on how the adoption and conversion has remained strong. But I guess if we do think about a period in the housing market where some geographies maybe do see price weakness or at least have greater risk of price weakness than others, should we think about your approach as kind of continuing to bake that risk into underwriting but still making offers in all locations? Or is there a scenario where, you have a big enough footprint of 50 markets and, maybe the market dictates you leaning into certain geographies and pulling back or pausing even in potentially riskier areas? Maybe just comment on that geographic kind of balancing act that's out there.
Hey, Ryan, it's Carrie. One of the beauties of being in now 48 markets is we really have a diversified portfolio that we can make trade-offs against, and we really do manage the business in that way. We can make trade-offs across markets, across home types. We can allocate capital differently depending on what's going on, and so we would look to do so if that was paramount. What I would say today, though, is we are positioned, we believe, really well for the back half of the year for the reason I said. One, gradual slowdown. We can respond to that. Two, we've been increasing spreads. We're positioned for that. And three, we've operated across all different HPA environments historically. And so as we sort of see HPA moderate, we're comfortable with our ability to thrive in that environment.
Great. Thank you very much.
Yeah, and Ryan, to add on top of that, just to provide some more context there, the way we think about it is if there's additional volatility, obviously our spreads would increase. Now, the promising signal that we're seeing is that the market also perceives the volatility, and we've seen conversion not materially change as a result. With that information, it may mean that we can be market share gainers across all markets, even as spreads fluctuate.
Yeah,
that's very helpful.
I don't compare though where we exit a market. I don't see that as a realistic scenario for us. We can price to that.
Right, makes sense. Okay, thank you very much.
Our next question comes from David Malinowski with Bank of America.
Hey, thanks for taking the question. It's Dave on for Kurt. I guess just we're curious principally about pricing mechanisms. I know it was commented on earlier. Just wanted, I guess, to think about for modeling velocity why you might think it's sustainable going forward, particularly as affordability is decreasing in your largest markets. And then I guess a quick follow-up, if rates are going up, how should we think about modeling interest expense for the year? Thanks.
So I think there's two parts to that question. One is just how we respond to a changing HPA environment for the balance of the year. If I got that right, I'll come back to the interest rate one. Yeah, I think it's consistent with the comments we made earlier about our expectations for housing may perform. To be clear, there's a very good scenario that housing is going to be stronger for longer, just given the fact that there's just structurally no supply out there right now. That being said, we are going to prioritize margins in this moment and make sure in this more uncertain time that we're meeting our margin targets. And so we're assuming the scenario is gradual slowing of HPA, gradual slowing of volumes, and we feel really good about our ability to respond to that. So on the second top question, which is around rates, I guess there's, as it relates to our P&L, I'd say a couple of things. We're certainly modeling rising rates into our forecast, understandably. We expect, however, that the overall impact to our P&L should be quite manageable. This is consistent with the comments we made last quarter, but just to parse it through, if you look at our senior loans and how we finance our homes, today that costs us about 70 basis points on a per home basis, just based on the terms we have. And if you extend that and look through to the end of the year, we'd expect that to increase on the order of 100 basis points. And that's based on a combination of things. Certainly the forward curve is this today, and how we assume we're going to mix in different senior facilities over the course of the year. The net of that increase, maybe 30 basis points, is pretty modest relative to our overall cost structure. And perhaps more importantly, it's important to understand that we pass on the full cost of interest to the customer via our spreads. Our objective is we're going to manage to contribution margin after interest to be neutral.
Yeah, that's helpful. Thank you.
Our next question comes from Ryan Tomasello with KBW.
Hi, everyone. Thanks for taking the questions. Just following up on the seller conversion, nice to see that still holding in strong despite the strong sellers environment, but curious if you've noticed any initial signs of a benefit to conversion rates in any markets that may already be starting to cool off. I guess where do you think that 35% plus conversion could go in a more normalized environment? And have you put any long-term internal targets around that metric?
Hey Ryan, it's Eric. Again, like I mentioned, we're quite pleased with some of the early evidence we're seeing that as we've increased spreads, obviously it's reflective in our gross margins and contribution margins. We have not seen a material damage to the conversion rates. And again, we had a hypothesis going into this, even back when we founded the company, that when there's the most uncertainty, that's when Opendoor is needed the most, which means that we're creating the most value when there's times of uncertainty. And thus subsequently we can actually capture that value that we're creating for consumers. We don't have a view today on what that could look like through any softening in the back half of this year, but we're certainly optimistic that our conversion rates will be steady at the very least. And so again, as we think about increasing spreads throughout the year.
Thanks. And then considering the geographic expansion that continues, can you say what level of, I assume, drag that these new markets are initially having on the consolidated business, maybe in terms of the margin delta between your most mature markets and your ramping markets, if that's the way you look at it, maybe on a contribution profit basis?
Yeah, it's Andrew here. The reality is pretty small in terms of the drag, and actually in our updated investor presentation, we actually shared some of the cohort profiles of what margin looks like in those markets, and they're all positive, and they're moving actually to profitability even more quickly than any of our prior cohorts have.
Got it. Thanks for taking the question.
Our next question comes from Justin Aegis with Berenberg.
Hi, thanks for taking the questions. Just wanted to follow up on the entry into the New York, New Jersey, San Francisco markets. Can you talk about any additional oversights that you guys take into account, given some of the uniqueness of the houses in those areas, if any, and then a follow-on after that?
Sure. Look, I think first of all, what I'd call out is our ability to enter the San Francisco Bay Area, New York, New Jersey is actually a testament to 8+ years of investment in our pricing and investment platforms. Our ability to underwrite a market is the fundamental gating item for us to enter a market. And that's what we look at, and we rigorously test that before we launch. And then actually, after we launch, our focus is not on growth in those markets. Our focus shortly after launch is making sure the models are performing the way we expect them to. And what we've seen so far is that that's what happens. And we monitor every market launch very, very carefully and very closely. And it's only once we feel comfortable with the risk we're taking on that we actually begin to apply our go-to-market playbook and ramp volume in those markets.
All right, that makes sense. Thank you. And then on the vendor management system that you guys called attention to in the letter, have you seen any improvement in kind of the inventory turnover? I know you mentioned 90 to 100 days, but is there reason to believe that system can bring those numbers lower and improve significantly or reduce the holding times?
We're relentless in our pursuit of operational excellence. And the team is hard at work, constantly turning over rocks, looking for opportunities, embedding process improvements into technology, into platforms, so that we can continue to drive down our cost structure. And I think one of the things you saw is that over a 3-year period, we've actually been able to drive 240 basis points of structural margin improvement. And a big portion of that is cost. And so, yes, we do believe that continuing to invest in our technology and operations platform, our transaction and operations platform will continue to yield cost savings.
I appreciate the additional color. Thank you.
As a reminder, if you'd like to ask a question at this time, please press the star, then the number 1 key on your touchtone telephone. Our next question comes from Stephen Ju with Credit Suisse.
Great, thank you. So I was wondering if you can give us an update on the uptake rate of some of your ancillary services. I think some time ago, at least for the title and escrow product, I mean, there was a pretty high uptake in those markets where they were rolled out first. So, where are the most mature markets now? And, is there any reason to believe why there should be some sort of structural ceiling, below 100%, almost full adoption? And, are those markets that are a bit newer in terms of these products who are being rolled out, are you still seeing a similar adoption path as some of the original/older ones? Thank you.
Specific to our title business, we continue to see strong attach rates overall. We do see different attach rates market to market as we launch, particularly as we enter newer different states. One of the things we're very conscious of, particularly early in a market's life cycle, is that we have flexible capacity. We can go up and we can go down as needed. And so, we're prioritizing that flexibility in some ways in the early in markets over just the absolute highest attach, because we actually think that leads to better system level profitability over time. And so we I would say, see very, very strong attach overall in our title business. We don't think it goes to 100% per se, but we think where it is a pretty good indicator, and we think that we'll see that in all of our markets.
Thank you.
That concludes today's question and answer session. I'd like to turn the call back to Eric Wu for closing remarks.
Thank you. I just want to say that I'm incredibly proud of the Q1 results, and as Carrie mentioned, props to the entire team for working hours and hours on servicing our customers and delighting them. We are managing our business with a great deal of discipline around our margins and cost structure, and more importantly, we believe we're going to be net beneficiaries and market share gainers from any upcoming volatility. Our future is very bright, and we are reshaping the entire real estate marketplace with a far superior digital product in a $35 trillion market. Thank you.
This concludes today's.
我们的未来是无比光明的，所以呢，我讲一下我认为比较重要的几个点啊，然后我就要去看能不能睡1个小时的觉。然后就是说，他讲过那个汇率的提升的问题，然后就是说，很多人担心说现在利率提升，但是我之前一个观点就是说很重要，就是说利率提升是一个动作，你要看利率提升的水平，所以现在利率提升，但利率总体还是比较低的。而且还有更重要的管理层刚才讲，他过去2年，然后把成本控制，然后把自己的那个毛利增加了2%，200个百分点，就意味着说其实是它的利润的空间更大了。所以说它的如果利率导致它的成本如果上升的话，它一方面它会转嫁给消费者，然后就是说在它这个售价里面会体现。第二方面呢，它通过内部成本的压缩就可以把这部分也消化。这是第一个。第二个可能更重要，就是说在所有不同的情况下这个公司都可以盈利。就是如果是这个公司说他一直提到那个 spread 就是说这个买价跟卖价的中间的差，这就相当于是毛利。他说如果是现在市场比较热比较热的情况下呢，因为人家怎么样都可以卖出产品，卖出自己的房子，所以作为 OPENDOOR 呢，它其实是本身被人家帮助不大，所以它能收的那个本身的那个差价，那个佣金就会比较低。但是呢，如果房价比较热，它如果持有一段时间，那个房价那个价差就会比较高，就是那个房价溢价，就是 HBA 就会比较高。所以就比较热的情况下呢，它的佣金低，但是那个房价溢价要高。但如果是现在房价如果要哪天转比较冷的情况下，就会相反，就是它可以那个房价的溢价就会比较低，但是呢，它可以向对方向卖主可以收取更高的佣金。 所以呢，这其实两者就意味着说，它不管房市是高还是低啊，是热还是冷，对它应该影响不大，它都可以盈利。但当然了，影响还是会有啊，就是还会有盈利，但是盈利具体水平肯定会有浮动，但是总体应该相差不大。所以说这就是我的理解。所以说这家公司总体来讲，我觉得没有问题。现在好像 OK， 好像盘后涨了16.92%，我这看到是，所以还不错。如果是开盘的话，如果明天没有涨到20%，我会有点失望，但是无所谓，就是说最终看长期嘛。我觉得这家公司现在应该是信心更强了，因为他非常清楚的讲到自己可以在美国每个市场都可以大有用途。第二个呢，现在已经真正实现会计盈利，然后第三个增长又很快，第四个它现在没有竞争对手，我说过只有一家 OfferPad， 但总体它比较控制，所以它的整体的收入增长就是不会超过OpenDoor， 所以一直是它一个小兄弟一样的。所以说总体来讲，它其实 OpenDoor 在市场里面就是没有什么明显的竞争对手，所以说就是跑马圈地。所以说我相信 Upstart、OpenDoor 都是类似的情况，就是未来几年增长，然后而且它现在有盈利嘛，所以将来应该没有任何问题。OK 吧，好吧，谢谢大家。然后我们现在有70个听众，算是不错。我估计也没什么问题，我们就先这样。然后我一会儿还要出去，然后下午要睡觉，然后晚上可能再仔细看一下财报，然后再给大家做视频，然后可能还要再讲一下 Square。我看一下，好像 Square 好像也涨了，对不对 ？Square OK 涨了10%，所以也不错。所以说就是好，就是说熊市就会把好公司跟差公司区分出来。我觉得 Upstart、OpenDoor、Square 这些毫无疑问都是好公司啊，不管熊市牛市，熊市只是给我们更好的机会，然后更低的价格持有而已，好吧？如果这样呢，我就去睡觉了。谢谢大家支持，我们就到此为止。OK， 干杯。